Hi, everyone. This is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. We haven't had him on for a while. I wanted to have him on, but it's very tough getting him because he's a very busy man. He's doing a lot of projects. He founded Minyanville, which is one of the most popular investing websites out there now. He's former hedge fund manager. He was one of the top hedge fund managers on the planet, and he's a 20-plus year Wall Street veteran. Todd Harrison, thank you for coming back on a Wall Street for Main Street podcast.
It's my pleasure. I don't know if I was one of the best traders on the planet, but I certainly did my best.
Well, you were definitely up there because I've read articles talking about how great you were.
Well, you stay humble in this world, or the market does it for you. I've learned that lesson over and over again. But your words are very much appreciated.
This is true, and even if you're at the top of your game, a couple of bad mistakes and Wall Street will turn on you. So that's just how the game works. But let's talk about the global macro picture first before we talk about the U.S. and the Fed. We've had Japan, just do tons of Abenomics. China and Japan have printed more money than even the United States has the last couple of years. It's an insane amount of money. The developing world, in my opinion, based on my research, is getting flooded with inflation. So you have China, India, Russia, Brazil. They've just been victims of their own, monetary policy and Jim Rickards' currency wars. Do you think the developing world is going to be able to survive, with its current monetary policy, or are they going to have to drastically alter their the way that they've been running their economies?
Well, they will survive for sure in some capacity or another. I think one of the, I think the path at this point remains unknown. We've been in uncharted territory from a monetary standpoint domestically for some time now, and it looks to me as if some nations abroad have now seeing the way the U.S. stock market has reacted to the policy, have copy and pasted that policy internally, and it remains to be seen. The other side of this trade is very much unknown through a historical lens because we've never been here before. I'm of the view that there are only so many release valves that can deflate the efforts that have been pretty much hand over fist for the last 5 years. And what that ultimately will be remains to be seen. It could be currency. It could be social, socioeconomic, geopolitical, as we're seeing now overseas. There were two paths that the U.S. could have taken, in my view, coming out of the financial crisis. They chose one, which was to continue to throw more money and create and print more money, as opposed to allowing asset classes and free markets to identify a point of equilibrium and through a free market lens and go through that process. So never having been allowed to go through that natural process, and the Fed going from a policy of being a buffer to a policy of being proactive and continually proactive in what they're doing. It's created a lot of imbalances in the system, and it's happening. I'm happy to be talking about these imbalances when we're at all-time highs in the market, because there's going to be another side of the trade that comes through. The question, of course, is when.
And by that other side of the trade, you're expecting then a sharp correction. Then are we talking about a 2008 type of correction or something a bit smaller?
Well, one of the things that I'm pretty confident, and I'm not confident about a lot of things, but one of the things I am confident is that the next financial crisis is not going to look like the past financial crisis. So I don't think it's going to be corporate balance sheets. Obviously, it's not going to. I think it's going to be a .com. It's not going to be real estate. There's going to be unintended consequences to this policy that are going to manifest, and that could take many, as I said earlier, many different forms. It could be through an equity correction, which has been a long time since we've seen a meaningful equity correction. For that, as a matter of fact, a lot of folks who have been trading for 5 years or less, or have been running money for 5 years or less, have not experienced a down tape with any sort of rigor. So when that turn comes, it's going to catch a lot of people by surprise. It could be currency. It could, in some way, shape, or form, be a function of the plumbing of the stock market, which has been a topic of discussion recently with regard to HFT. But when when you're talking about high frequency trading and 50% of overall volumes, there's a lot that remains unknown and untold with regard to the plumbing in the financial markets, and that could be something that manifests in some capacity. So I'm not smart enough to know where the dam will next spring a leak, but it's going to happen.
Exactly, and based on past financial history, what has happened is that every time there's been a new Fed chairman within less than a year, the market has tested that Fed chairman, whether or not they're going to take away the punch bowl or keep spiking the punch. And you can go back and look from the transitions from when Paul Volcker inherited the Fed, when Alan Greenspan took over, when Ben Bernanke took over, and there's clear examples of this in the market. That you have the 1987 crash, I believe. Based on my research, that everyone was bullish prior to the 1987 crash because the market had kept going up and up and up, right? And then all of a sudden it came out of nowhere.
Exactly. I mean, I don't disagree with what you're saying. Again, I'm not smart enough to, my crystal ball is in the shop with regards to what's next. But, as I sit here and talk with you on this April 25th of 2014 at 11:30 in the morning, obviously we're seeing a lot of the froth come out of high beta, and that continues to be the story in the marketplace, and whether that is going to lead the broader tape down much like it let it up, or if this is letting some of the froth out of the high beta realm as a rotation within the context of the broader market holding in, that remains to be seen. I think the market comes for sale. And I thought the market would come for sale, and it's been a contrarian and wrong view for some time. But I'm not necessarily betting. Right now I'm flat exposure. I'm trading. I'm not necessarily making any big bets because the market's trading a bit funky, and I'm going to let the process of price discovery demonstrate itself.
Yeah, and there's also been a lot of sideways chop, and maybe that's because really the last couple of years, at least to me, in terms of flow of funds, it seems a lot of foreign flight capital has left China, it's left Europe, it's left England, it's even leaving Japan, and it's come to the U.S. markets, in the U.S. real estate market, it's come into the U.S. bond market, it's come into the U.S. stock market, and that's because, it's not just the Fed that's printing money, like I said, it's all global central banks that have basically printed money. And the valuations on some of these companies were just getting absurd with the high beta names that you meant. Well, you didn't mention any of the high beta names, but you talked about some of the momentum stocks in the technology sector. The valuations were just absurd, and it just didn't make any sense whether or not we were going to get to the point where we were going to have another type of technology bubble where we had companies like Tesla where they didn't even really have any earnings yet, and they were going to go spend another $5 or $10 billion on capex, and the market was just shrugging off that type of capex investment without any promise of profits.
Yes, in many ways we've seen this movie before. And listen, innovation is a terrific. Is a terrific evolution that continues to drive this country forward. There come times when there's a disconnect between perception and reality, and that's where, ironically, that's where stock market traders make their living in that chasm between perception and reality. Ultimately, the price action is going to be the ultimate arbiter of whether it's perception or reality. Many people would argue that the price is reality, and I don't disagree with that. I'm talking about looking forward, for the next opportunity in the stock market and as a way to preserve wealth and create wealth going forward. These are pretty dynamic times, interesting times to say the least, not just financially, but through a lot of different lenses, through the world over. So I'm pretty confident we're going to look back at this stretch of time and and say to ourselves once again, what were we thinking? But that's going to, when that manifests, it obviously remains to be seen.
And it's not like you and me, Todd, have any control over the people at the Fed. I mean, these are people with PhDs who have IQs over 160, and they think they're smarter than us. They think they've read a lot more academic papers and books than us, and they're not really going to listen a lot to what we have to say. They're going to keep doing what they have to do to make sure the government gets its tax revenues. They want to keep the asset prices higher, et cetera, et cetera.
Well, I could argue that long-term capital, was a lot smarter than us also, and we know what happened to them. I mean, listen, I have as a father of three, I have a vested interest in a better world going forward than we have today. It's going to be a tricky path. As we hand the baton, to our children going forward, it's going to be, there's going to be, elements that and sectors and areas where I think there can be some really good opportunities going forward, and there's going to be others that disappear entirely. This is, the nature of the markets, the nature of change, and the nature of the world we live in. The best we can do is navigate it and try to keep our sensibilities as we do.
Those are good points. And you talked on our last interview, you said one of the best long-term investing opportunities you saw was the marijuana market and the legalization of marijuana. But now we have the e-cigarette market, which is kind of going to be tied to that. A lot of companies are planning on, doing the e-cigarettes first, or they already have the e-cigarettes and then they're transitioning then to the marijuana. Do you still see that as a major opportunity over the long term? And what other long-term opportunities in other sectors do you see? Sure.
So as a point of context, we started talking about the cannabis space in 2012. And funny, at the time it was a bit taboo. You couldn't really talk about, that space without really being looked at with crossed eyes. Obviously since then we've seen a lot of press, a lot of movement, a lot of legislative
dominoes
come down, and for good reason. Listen, the reason the original thesis for the space was simple, right? It increased tax revenue, lowers the prison population, lowers the crime rate, and then the kicker for me from an investment standpoint is that it's not covered on Wall Street, or was not covered on Wall Street when we first started talking about it, and as a function of that, there was no institutional money in the space. Since then, we've started to see Wall Street get involved in a couple of different ways, and a lot of these stocks, and I don't advocate trading the penny stocks. I think there's a few legitimate companies in the space right now, but those companies, since we first started talking about this thesis, have run upward of 500-600%. So I think that the first phase of the investment thesis is really is coming to an end, which is the rising tide lifts any and all boats that are associated with it, much like we saw with the Cisco's and Dell's and Microsoft's of 1999. And now the next phase is going to be sifting the winners from the sinners and identifying who are the legitimate companies in the space, and that's going to start to attract institutional money. And we've seen Morgan Stanley and Bank of America initiate some of the stocks or a particular stock in the space. So we're starting to see that thesis play through, but it's not. There's a lot of tracking risk right now, meaning you can't just throw a dart at any of these stocks and expect them to rally as they have in the past, because that's not realistic. That's not life. That's not reality. So it's going to be, in my view, a longer-term horizon, and not just necessarily in the growers, but up and down the food chain, whether it's vapors, edibles. There's going to be a number of tertiary plays that I think are going to benefit. And one of as the demographic ages, and we're seeing a much higher concentration of the younger folks, upward of 70%, approving the legalization of marijuana. I think this is only going to become stickier as a long-term secular trend, and not so much. in addition to medical, which is taxed at one rate, the recreational, which is taxed at a much higher rate, obviously there's going to be some incentive for states to roll that out depending on how Colorado plays through. And Colorado so far is beating expectations in terms of revenue from cannabis.
Yeah, and D.C., Washington, D.C. Is very close, I think, to fully legalizing marijuana. I think Maryland has already started the process of partially legalizing it. You've had a few other states start. They're all going to fall like dominoes because they're going to see how well, the marijuana tourism is doing, how it's taking away the tourism dollars from, I think, the Netherlands and Amsterdam. I think already Amsterdam's tourism business has gotten hurt because Colorado has more liberal marijuana laws for tourists to go, and I think Washington State does too.
And it's going to be, just to be clear, like there will come a point where some bad things happen when people act irresponsibly, no different than alcohol, right? And it's going to become some social lashback against this theme. But the onus of responsibility, whether it's alcohol, whether it's guns, whether it's cannabis, it comes back to the person. There are legitimate medical applications, and I think that's the first focus, and we're seeing that play through in the marketplace and on various iterations. And anybody who wants to get involved in this space needs to do their work, and they need to diversify their risk, in my opinion.
Yeah, exactly. And people need to take responsibility. I'm a libertarian. I don't want government coming up with all these rules and mandatory regulations telling people, that they can't smoke any marijuana once it's already legalized, or they can only buy so-and-so, blah, 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 blah. People should be responsible for themselves. They shouldn't need government telling them 10,000 different things that they have to do in order to be a functional human being. We want, productive, hardworking people that contribute to society. But in terms of the marijuana stocks, a lot of them just are not profitable, like you said at this point. The market just shrugged off a lot of equity dilution for the companies that weren't making any money because that was the hot trend. But now you're going to get to the point where the market just doesn't give 600% gains perpetually.
I agree.
So if you can get I've had 600% gains in the past over a 3 to 5 year period, but you're not going to be able to just, unless it's like the next Apple computer or something groundbreaking like that where the company's, very profitable very quickly in its early cycle. When the company's starting off, you're not going to get those types of gains because normally with those stocks, they're not profitable and the market drastically, priced in way ahead of time, and then it's going to have a very painful correction.
I agree.
Now, in terms of the commodity market, we've had still a decent amount of growth in the developing world. Commodities have been in a bear market. Most commodities have been in a bear market really for the last cyclical bear market for the last 2 or 3 years. Do you think that food and energy and precious metals are going to separate themselves from, say, base metals? Because even people in the developing world, they have a higher standard of living. They're making more money than they were, a decade ago. And they're still going to want to have a car, maybe a small car, put gasoline in the car, maybe eat more calories and protein. And the cultures in India and China tend to prefer precious metals for savings instead of putting money in a bank account.
Well, I've been relatively vocal over the course of the last few years that we continue to see inflation in things that we need and deflation in things that we want. So I do think that there will be a natural relative bid to the ags and the food complex relative to some of the things that folks want. So I looked at I was going around. I was looking at plasma TVs recently, and they're dirt cheap. And every time I see these commodities in the marketplace, the things that folks want as opposed to need, I think is a real bifurcated environment right now on the inflation front. Anytime you hear about team, the team inflation. I kind of cringe because it really depends what you're looking at. Food and energy. If you don't eat and you don't need to get from A to B, maybe, inflation has been tamed, but I think that for the majority of people, they're getting squeezed by the prices of things that they need, whether it's food, whether it's energy, whether it's education, whether it's anything that's in demand in today's society. And I think that's going to continue. I do believe that there will be a deflationary phase that comes through the marketplace at a point, whether that's in any way related to the Fed pulling back. Whether that's too intuitive remains to be seen. But when you look at the world we live in, and this is something we've talked about through the years, and I think one of the things that the Fed is just fighting from an uphill battle on is, we live in a digital world. The internet is the most deflationary invention of all time. You can have access to any number of goods and services at a much lower price, so margins continue to get squeezed because of the supply in the marketplace, the supply of information, the supply of vendors, and you really, this is where I think there is a fundamental disconnect between the Fed reflating and continuing to attempt to reflate, and central banks around the world continuing to attempt to reflate, and just the secular environment that we live in, where there is just a tremendous amount of supply, pretty much of anything that you would want to buy, driving down margins. So I do think that at a point, again, timing is everything, but I think at a point we're going to see, deflationary waves come through the marketplace, and the best place to be in that environment is cash.
It's very interesting. And deflation is a free market. So if there is a free market in technology, like you mentioned, with the plasma flat screens, there's competition globally from Korean firms, Japanese firms, American firms, European firms, all producing those types of TVs. So there's not, the Federal Reserve or this government or that government saying you have a monopoly and you're the only company in this country that can produce those TVs. That's not what happens. So when you have all those different firms competing, that's good for consumers. They get a higher quality good and service at a lower price. And, that's beneficial deflation. But, the Fed, the way I view inflation is basically 100% created by the government. So maybe there's temporary inflation due to wage prices increasing, but the market would naturally correct for that. But the inflation we have now is just really bad stagflation that all the Keynesian central bankers of the world have just flooded the economy with, and they've created, these asset bubbles throughout the years. So you have asset bubbles over all these different asset classes, and then they have to be reinflated because the banks are so leveraged, the hedge funds are so leveraged, and everyone is not everyone's gambling that the Fed's got their back with the put protection.
If not a call protection.
Now, Todd, what worries you the most?
Hold on one second, please.
Okay.
I'm sorry. Can you say that again?
Now, what worries you the most going forward over the next 5 years? Is it the stupid behavior of politicians? Is it what kind of crazy schemes the central banks can come up with?
Well, I'll tell you. What concerns me is more the socioeconomic sphere. We're sitting here, about 1.5% from all-time highs, and I can't tell you many people who feel like we're at all-time highs. And this is how it felt to me, at the end of 2006, 2007. It's just a real disconnect between the market trading at all-time highs and the majority of society who continues to get squeezed, in part due to the inflation and things that we need, and lower stagnant wage growth, unemployment, and things of that nature. And there's a lot of, there's a lot of ticking time bombs, in my opinion, out there that could come home to roost at any time, whether it's student loans, whether it's it's not going to look like past crises, but if there's one thing that I had to focus on that certainly concerns me, it's just the social mood element of it. And we've been talking about this in Minyanville for a good decade now, or almost a decade. in terms of the tricky trifecta, and the first phase being societal acrimony, the second phase being social unrest, and the third phase being geopolitical conflict. And we could check the box in the first phase, which was whether the societal acrimony, and we've seen that, the pushback against the banks. We've seen it against oil after the Gulf spill, the vernacular, the perception that the capitalism is profiteering, speculation is profiteering, the war on capitalism. I mean, we've seen this play through. So the second phase, social unrest, we've seen the riots, we've seen Occupy Wall Street, we've seen a lot of social unrest overseas, around the world. And now, to me, the biggest fear is that next step, is that geopolitical conflict, whether that's Russia and Ukraine, whether that's North Korea, whether that's China and Japan. I don't know, but the needle's pointing in that direction, and that's to me a direct correlative to the economics hardship and policies that have been put in place when we have effectively given the drunk another drink with hopes that they don't sober up, as opposed to letting the free markets take their medicine. I think that they're very much interconnected, and I hope I'm wrong. As I said, I was a father of three, and as somebody who's been to 60 Grateful Dead shows, I'd much rather see the world hold hands and sing Kumbaya. I just don't see that as a realistic path.
Yeah, and in terms of the Arab Spring, what we had, people the mainstream media brought up, democracy was the reason the Arab Spring started. That's not the real reason. The real reason the Arab Spring started was because of inflation in their currency, and the people didn't have any food. So there was protests over, the basic necessities of life, and then that's what started all this other stuff. So I think the global economy in general it's been slowing down. China's definitely slowing down. I mean, their statistics are ridiculous, but I mean, every government lies about their statistics, economic statistics. But China slowing down has tremendous repercussions for the rest of the world. That means, people in Brazil, people in Australia, people in Canada, they're not going to be having as many high-paying commodity-producing jobs maybe as in the past. But and then, that's going to lead to social unrest because people thought, they were thinking linearly like most of us humans tend to do. Things were getting really good for the last 10 years. If you lived in the developing world, your quality of life was improving. Then all of a sudden, you have a nasty economic shock, and now you have to adjust to a much lower standard of living when people, didn't have very much to start with. There's going to be a lot of anger and frustration. And
we're seeing that. That's what we're seeing. So, it is what it is. You can be a part of the problem or part of the solution. I try to be part of the solution in my everyday life, random acts of kindness, and try to do the right thing by people. All you have is your name and your word, honesty, trust, and respect. I mean, if you want to start to build a better tomorrow, you start, inside, and you start with your family, and you start with your friends, and you try to move the needle. It's not going to be easy. It's not going to be necessarily fun, but it is going to be what it's going to be. So, we got to take what we got, not what we want, and make it better one step at a time. That's my philosophy, and that's the way I try to live my life.
I completely agree, and I think everyone, whether you're an investor or you're a business person, you're going to have to be very entrepreneurial, and you're going to have to manage your investments. You're going to have to learn how to hedge. If you're not a professional, you're going to have to learn what a hedge is. And you're going to have to, the economy can switch from inflation panic to deflation panic in, a week or a month very quickly. And we're at the stage here where we haven't had that much volatility for a number of years, right? Really since 2007, 2008, we haven't had that much volatility. And I think one thing that we're going to have a bull market in going forward is volatility.
No, I agree. The volatility is by definition the other side of liquidity, right? So think about it. If you're trading a thinly traded stock, if you try to buy any size or sell any size, you're going to move it. If there's a lot of liquidity in the marketplace, then volatility levels by definition are going to be much more muted. So the combination of the liquidity that's been pumped into the system, whether it's by the government or by HFT, which is 50% of volume these days, I think has artificially capped volatility. I see, the longer-term trend line on the VIX. 10 is the level that, anytime it gets close to 10, it's been a pretty decent opportunity to buy it. I do not trade volatility, the VIX, the VXX, but there are ways to implement it in your portfolio via stock replacements or married puts or things of that nature. But if you don't know what you're doing, you should probably stay away, because the market is not geared towards rewarding the little guy these days.
And very well said, Todd. And the little guy has so many disadvantages now, but if they're learning and reading Minyanville, and I think they should definitely check out your book too, because I listened to you give a long presentation about your book and talking about the life and all the research work required to succeed investing and trading in the markets. It's not easy to succeed. People think it's pretty easy to make money in stocks. It's definitely not.
Well, I appreciate that. We're at Minyanville every day, and we certainly appreciate the opportunity to speak with you today.
And please tell our listeners more about any paid newsletters you offer on Minyanville, and anything else that you'd like to say in terms of your charity, if you want our listeners to become aware of your charity.
I mean, all of that stuff could be found online. I'm not on the phone with you to shill any of our products. We have some great products. The Buzz and Banter is a great product. We have some great newsletters. Minyanville Pro is a terrific platform. It's very much like an ESPN Insider, much better experience. But people can come check that out. If they like it, they stick around. If they don't like it, they can move on. Free will is one of the few things in this world that can't be outregulated.
Well said, Todd. Thank you for your time, and we'll have you hopefully back on again soon.
Thank you so much. Bye.